Hello, everybody. Welcome back to Cup of Joe. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Stocks saw a strong bounce back during the middle of last week, but the rally was muted on Friday as soft employment data came out and suggested that economic growth may slow if hiring is slowing down. So this leaves the S&P 500 still in bear market territory so far for 2022. And it is nice to see these intermittent rallies during the market dip, but we think it's reasonable to expect continued volatility in both stock and bond markets. And now, while we at Argent Bridge are trying to set this grounded expectation, we're also trying to foster a tone of patience and confidence as we all weather this market downturn. So to help us all do that, we wanted to give you some positives to focus on in this tumultuous environment. Now, the first positive would be that bond strategies are actually paying more income. As the Federal Reserve raises interest rates, the coupons on new bonds being issued go up as well. And this is the same goes for savings accounts and money markets. My colleague Cecile recently shared a piece with me from Vanguard, which showed that the bulk of a bond investor's long-term return actually comes from the income payments and doesn't come from the price return. So while price volatility is certainly uncomfortable for bond investors, the increase in income is definitely a good thing. Number two, price corrections are a buying opportunity. Now, this benefit is twofold. It's an opportunity for the managers of the active strategies in which you're invested, but this is also true if you're already investing on a plan, maybe routinely contributing to your 401k or thrift savings plan, and bear markets increase the compounding power of that savings plan routine. And of course, if you have extra cash to put to work, it's also nice to be buying while prices are down, and that's intuitively a good thing. Number three, and this is an important one, remember to control what you can control. In times like these, it's real easy to feel at the mercy of runaway inflation or a haywire stock market, but we remind you some controllables. Your expenses, reviewing your expenses, identifying areas where spending may be more discretionary, or even identifying expenses that could be put on pause for a little bit and then resumed once inflation has come down. You can also control your spending behavior. If there are some known purchases down the road, you can be a lot more intentional about the timing of those purchases, and maybe along the way do some more comparison shopping than you typically would to find a better price. Now, number three, and this is a big one, sticking to your investment plan. Yes, this is a controllable, sticking to your plan. Don't insist on making any big changes that may be driven by emotion. Certainly don't participate in any panic selling. Remember that volatility was already baked into your plan when we helped you build it. So sticking with your plan is actually the best course of action. And the final one is, by all means, make it easier on yourself to stick to that plan. Control those things which affect your emotions. These may be things like, how often are you looking at your accounts online? Are you running to the mailbox to look at your statement each month? Control what media you take in, what you're watching, what you're reading, and certainly do not let any unknowns stress you out. Ask your advisor. Give us a call, shoot us an email. We will respond and be happy to make sure that we provide you with clarity. Now, the final positive we want to offer in this environment is everything we are doing behind the scenes to help you. We use these market downturns to look for strategic opportunities in your accounts. These would include things like Roth IRA conversions or harvesting losses in accounts to offer you tax benefits. I am focused on finding investment opportunities all throughout your portfolio, looking for proactive rebalancing to take advantage of that price dislocation effect. Maybe this is a good time to diversify a concentrated stock position you might have, and of course, looking to opportunistically put cash to work. And currently, we are able to once again use low risk savings vehicles such as treasury bonds and CDs. These are things which have been yielding next to nothing for most of the last 14 years. So we're incorporating those back into portfolios once again. So these are positives we wanted to give you to let you know that we are hard at work trying to give you that feeling that everything that can be done is being done. And we wanted to give you these positives to help you try and do the same. So if you have any questions about anything we've discussed or anything you're hearing about out there, please feel free to let us know. Bye-bye.